The second one, rather than the other dynamics, is what really stands out to me. The company is currently undergoing a product refresh, and I believe that some of the pricing discounting reports were exaggerated. In addition, when you have a stock move of 20%, like this one has, and the company is truly at the forefront of important technology for the next decades, I think that sometimes people look at this and think, hey, I could make a quick buck trading this or cover my shorts. Several drops in Tesla stock price currently at $233.19 per share have been predictable so far. This year, there was a mixed reaction from investors. Some were bullish about the company's prospects, while others predicted that Tesla's stock would fall to $150 by year's end due to this. So, let's try to figure out why Tesla's share price fell in 2022 and see if it's going to happen this year or last. Optimists argued that the stock really fell more last year than it did this year, but it finally rebounded this year. There are a lot of factors that contributed to the decline in Tesla's share price. One of them is the tech market, as shown by the Invesco QQQ ETF, which fell 23% over the past year, considering that Tesla itself fell 66% during that same time. It's safe to assume that other factors also played a role. If last year's global chip shortages and logistical nightmares weren't bad enough, Tesla might have taken a particularly hard hit. Elon Musk's fixation on his Twitter takeover, which was front and center for the better part of a year, but is now seen as a boon for Tesla investors, is the real culprit behind this year's decline, according to one analyst. The electric car maker's stock took a nosedive in April, after it released data on its first quarter vehicle production and deliveries. Despite a nice year-over-year growth in deliveries, the report failed to impress Wall Street analysts, who have expressed mixed opinions on the update. Although some analysts were pleased with the 36% year-over-year growth, others admitted that the nearly 425,000 deliveries were disappointing, considering this. One analyst maintained an underperformed rating for the stock and set a 150 12-month price target. The rationale behind this is that earlier this year, Tesla implemented significant price cuts for its vehicle lineup, which caused media concerns about possible demand softening. However, Tesla CEO Elon Musk stated during the company's fourth quarter earnings call that the lower prices were driving a significant surge in orders, and investors eventually warmed up to the idea of price cuts. Cuts are evident in the skyrocketing stock price year to date. A portion of the price cut was basically recouping the higher prices from last year, when Tesla had to charge more for its vehicles to cover its higher costs. Now that some of those costs have begun to level out, it makes sense for the company to pass the savings on to customers, as lower prices usually lead to higher unit sales. However, according to Bernstein analyst Tony Sacconaghi, there will likely be more price cuts in the future. Sacconaghi notes that, although still low, Tesla's vehicle inventory has been growing, and that the wait time between a new U.S. order and the expected delivery window is currently low on all models with the exception of Tesla's Model Y. He believes that these factors indicate a challenging demand environment and, possibly, more price increases later this year. Bernstein has a price target of $150 for the stock for the next 12 months, indicating that he believes shares are overpriced. Even though Tesla stock has skyrocketed from its late April low of $135 to its current price of $230, investors remain pessimistic about the stock. Quite a number of Wall Street banks have recently downgraded Tesla stock. UBS was the first to do so, stating that they were downgrading to neutral on the stock due to their belief that the company's recent strong share performance accurately represents the surge in demand following price cuts and the good performance of its executives in 2024. 0.5% drop in morning trading put Tesla stock on course for a fourth consecutive decline. Shortly after, UBS analyst Patrick Hummel downgraded the stock from buy to neutral after 13 months. Not long after that, two more prominent Wall Street banks followed suit. Even though Tesla doesn't trade based on fundamentals, analyst Dan Levy of Barclays downgraded the stock from overweight to equal weight, arguing that the recent rise disregarded near-term concerns regarding the stock's fundamentals. Regarding the current position of Tesla shares relative to 1 month ago, Levy raised some intriguing issues. There are three primary arguments that support Levy's downgrading thesis. Recent supercharger deals, the AI effect, and the benefits are all up in the air. But the most crucial part is the rally's multiple expansion, which coincides with the third Tesla downgrade in July. Morgan Stanley lowered Tesla's price objective from $200 to $250 and downgraded the company from overweight to equal weight. Here, we are not attempting to declare the end of the Tesla rally, Adam Jonas, an analyst at Morgan Stanley, elaborated. And we've established from our conversations that investors are still quite skeptical. Underrepresentation of the brand. Mark Delaney, an analyst at Goldman Sachs, downgraded Tesla stock from buy to neutral. We now see the market giving the stock more credit for its longer-term opportunities. Delaney said, however, we are cognizant of the difficult pricing environment for new vehicles, which we believe will continue to weigh on Tesla's automotive non-GAAP gross margin. For the current year, following Delaney's writing, DZ Bank to lowered Tesla's stock recommendation from buy to sell, resulting in a price reduction of $210. Not only that, but almost 20 analysts have lowered their earnings projection for Tesla, pointing to short-term dangers. In addition to Tesla's expensive profit-to-spending ratio, despite the fact that the lack of dividend payments and the stock's volatility are significant drawbacks, investors should take note that Tesla is building inventory for a good purpose. In its fourth quarter update, the company detailed its ongoing efforts to achieve a more balanced regional mix of production and deliveries. As a result, Tesla's inventory of vehicles is expected to gradually increase throughout the year, which could lead to higher prices, as anticipated. Investors are desperately hoping that this won't happen for a number of reasons. But it's still anyone's guess whether Tesla stock will fall below $150. Elon Musk's conviction that Tesla's sales volume may improve due to the expansion of Tesla's product lines is one factor that could contribute to the company's rising rather than dipping. While Elon Musk hinted in his master plan, spoiler alert, it involves expanding Tesla's lineup to cover all the major forms of terrestrial transport. The company's bright future is undeniable, and with prices so low right now, it's a great time to invest. However, some analysts are of the belief that Tesla is meant to be a long-term investment. So if you're looking for quick profits, you might want to look elsewhere. In spite of a 16% decrease in August, veteran Tesla bull and Bush analyst Dan Ives recently told CNBC that he is still bullish on the company's stock. I see this as more of a sell-off following concerns about China in the quarter. I've already mentioned that the analyst sees this as a chance. And at these prices, Tesla is killing it. Stock of Tesla fell following the electric vehicle giant's announcement of a 20% increase in Q2 profits to 91 cents per share, and a 47% increase in revenue to $24.93 billion. Revenue totaled $24.22 billion, up 43% from last year, and experts predicted profits to rise by 4% to 80 cents per share.